Gold just blew past $4,200 an ounce. That's up nearly 60% in a year. And get this, Costco, yeah, the place you get your rotisserie chicken, is selling up to $200 million in gold bars every single month. They sell out within hours. It's not just us either. Central banks worldwide have been buying over 1,000 tons of gold for 3 straight years. And for the first time since 1996, they now hold more gold than US Treasury bonds. So what is going on? Why is everyone suddenly obsessed with gold? First, let's grasp how rare this stuff actually is. All the gold ever mined in human history would fit inside a single cube just 72 feet on each side. That's it, less than 4 Olympic swimming pools. If you spread it all out on a football field, the pile would only come up to your chest. That's 6,000 years of human effort. And the craziest part, 2/3 of all that gold has been dug up since World War II. Before that, there just wasn't much around. The supply is incredibly stable. It doesn't swing wildly like oil.
So any price explosion isn't about supply, it's about demand. So who's buying? Well, almost half of all gold still goes into jewelry. China and India dominate, buying 60% of the world's supply. I went to an Indian wedding once. The bride had so much gold, she looked bulletproof. This deep cultural demand creates a massive, stable floor for the price that never really goes away. But here's where it gets serious. Central banks. Underneath New York City, there's a vault straight out of a heist movie. 80 feet underground, 9-foot thick walls. It holds about 4% of all the gold in the world. But most of it doesn't belong to the US. It's owned by 36 other countries. And those countries, along with others like Poland and Kazakhstan, are buying like never before. This has led to a massive shift. For the first time in almost 30 years, central banks hold more gold than US treasuries. Why? They're worried. Inflation is high, the dollar isn't the sure bet it once was, and after Russia's assets were frozen in 2022, every country is nervous their reserves could be next. You can't freeze a bar of gold.
And that brings us to the third group of buyers, us. The Costco phenomenon is real. The demand was so insane they had to limit people to one purchase every 24 hours just to keep from selling out instantly. The appeal is simple. Physical gold is yours. You hold it. No bank can touch it. The alternative is financial gold, like ETFs, basically paper that says you own gold. It's cheaper and easier to trade, but in a crisis, it's still just paper. The global trade is controlled by just 3 cities, London, New York, and Shanghai. But the demand is now coming from everywhere. So what does it all mean? Gold's supply is fixed. Mining is predictable. This entire story is about a global crisis of confidence, a flight to safety on an unprecedented scale. When governments are ditching the world's reserve currency for a lump of metal, and when you can buy that same metal next to the frozen pizzas at Costco, it's not just a financial trend. It's a signal that the fundamental rules of money might be changing right under our feet.
We all know what gold is, but do we know what makes it move? It's a strange asset. A stock pays you dividends. A bond pays you interest. Gold? It just sits there. You can't value it like a normal investment. The only thing that matters is supply and demand. And that's where things get weird. You have 2 main buyers, jewelry lovers and investors, and they move in opposite directions. When the economy is great, people buy necklaces and rings, but they put their real money in stocks. When the economy tanks, jewelry shops are empty, but investment demand for gold explodes. Just look at the last year. Jewelry consumption dropped 11%, while investment demand drove gold to record highs. In theory, this should balance everything out. In reality, gold prices swing like a pendulum in a hurricane. There are 2 hidden forces at play. The first is love, a deep, psychological, almost primal love for gold. It's been valuable for 6,000 years. Every single culture on Earth values it. Financial analysts have a name for the true believers, gold bugs. But honestly, there's a little gold bug in almost everyone, just waiting for a crisis to hatch. This love creates incredible volatility because gold has massive crowd potential.
Everybody gets gold. Your grandma gets gold.
So when it starts moving, everyone pays attention. The second force is pure speculation. A huge number of people buy gold for one reason. They hope the price goes up so they can flip it. They're not thinking about hedging inflation, they're thinking line goes up. And since it's mostly regular people, not Wall Street pros, buying gold, you get that classic human behavior. We buy when it's rising, and we panic sell when it's falling. Professionals just call this noise, but this noise is deafening. Over the last 50 years, gold's annual volatility has been about 20%. That means in any given year, gold can easily swing up or down by a fifth of its value. So while people call gold safe, it is definitely not stable. So why is gold absolutely ripping right now? It started 2024 around $26.50 an ounce and just blew past $4,200 in November. That's nearly a 60% jump in a year. The most obvious reason is that the biggest players in the world are buying: central banks. They've snapped up over 1,000 tons of gold for 3 straight years, and they hit the accelerator in the third quarter of 2025. That builds a solid floor under the price. On top of that, you have fear. Geopolitical tensions have been high all year. The Middle East, Ukraine, US-China trade spats, all of it pushes people toward the safety of gold. And then there's the dollar. The US dollar has weakened significantly in 2025, falling over 10% in its steepest drop in 3 decades.
When the dollar falls, gold almost always rises. But here's the strange part. Normally when gold soars, stocks sink. In 2025, they both went up. That tells you this is a very unique moment. Here's how it likely played out. The central bank buying started the rally, a slow, steady burn. Then, as the price started hitting the news, it triggered that universal love factor we talked about. And then, speculation kicked in. Costco started selling gold bars, and suddenly it was mainstream news. Your friends, your family, everyone on YouTube was talking about gold. The more people talked, the more people wanted in. It was a classic case of FOMO. In 2025, we saw nearly $1 billion flood into gold ETFs in just short bursts. That's a tidal wave of money chasing the same asset. And once a rally like this starts, it becomes self-fulfilling. People buy because the price is going up, which pushes the price higher, which makes more people buy. We've seen this movie before, in 1980, in 2011. Gold goes on these massive parabolic runs driven by fear and greed. And then, eventually, it crashes and stays quiet for years. Will that happen this time? Nobody knows.
Okay, the big question. Should you actually buy gold? It's having an insane moment. Prices are up nearly 60% from a year ago, hitting over $4,200 an ounce. Costco literally can't keep gold bars in stock. And central banks are buying more gold than treasury bonds for the first time in 30 years. So what's the real story here? Let me hit you with some uncomfortable truths. First, the good. Gold's biggest advantage is that it zigs when stocks zag. When the market crashes, gold often goes up, making it great for diversification. It's also incredibly liquid. The market is massive, trading 24/7. And unlike every currency on Earth, it can't be printed. There's a finite amount. But here's the thing. Professional investors mostly hate gold. Over 80% of professional funds don't touch it. The ones that do usually keep their stake under 5%. Why? First, the volatility is insane for the return you get. Gold is more volatile than stocks, but over the long run, it delivers less. From 1971 to 2024, stocks returned 10.7% a year. Gold, just 7.9%.
And gold can be brutal. Imagine buying gold in 1980. You would have watched it fall 70% and stay down for 20 solid years. 2 decades of losing money. The second reason pros hate it, you can't quantify it. They love data, earnings, cash flows, economic indicators. With gold, there's nothing to analyze. The main drivers are love and speculation. You can't put that in a spreadsheet. If a fund manager loses money on gold, they look like an idiot explaining it. And if they make money, the client just thinks, I could have done that myself. But for regular people, this is actually an advantage. The fact that you can't quantify gold means you don't have to worry about hedge funds outsmarting you with complex algorithms. Everyone is on equal footing. When you buy gold, you aren't trying to beat Wall Street. You're trying to protect yourself from chaos. And at that job, gold is pretty effective. Now some real talk, and this isn't financial advice. 1. Gold is volatile. Don't expect stability. It can easily drop 20 or 30% in a year. 2. Gold only works over very long periods.
Think 10 to 15 years minimum. In the short term, its price has almost no correlation with inflation or anything else. 3. Physical gold has high transaction costs, sometimes up to 20%. Costco is decent, but you still have to store it safely. 4. Don't put all your eggs in one basket. Keep it to 5 or 10% of your portfolio, max. It's insurance, not your entire strategy. 5. The taxes are higher. In the US, it's taxed as a collectible up to 28%, which is more than stocks. 6. Ignore the price predictions. With gold, it's all noise. Just decide if you want exposure and then stick with it. So let's wrap this up. If you're looking for steady, predictable growth, buy index funds. Gold is not that. But if you're worried about inflation, economic chaos, currency devaluation, or you just want something tangible that can't be printed or sanctioned, then yeah, gold can make sense. Just keep your allocations small and your expectations realistic. The truth is, nobody knows where gold goes next. Not the experts, not the central banks, not me. It moves on emotion, fear, and collective belief more than any other asset. And maybe that's exactly why it's been valuable for 6,000 years.